S&P, as you can see on your screen here, exactly flat on the day. Probing lower, but just does not want to give it up, which is what I would be hoping for, is for it to give it up. As per usual, if you have any questions, please put them in the Q&A button on the Zoom toolbar. And if you just want to chat and say hello, feel free to use that chat button, but I generally won't catch any questions in there. As we usually like to do, I start off with a couple things. So I wanted to talk about implied volatility, which I view as to be at a low. So let's start with why I think that is. First, let's look at the sentiment page here. I'm sorry, the index page. If we come down a little bit, we can look at realized volatility. So the the 1 month implied volatility is currently at 11. So I believe it was last week we were talking about this, that it was at 14, and then we have the holiday and we have some of those explosive moves from early November roll out, right, when we were ripping higher. So those big moves rolled out of the window. So realized volatility is calculated in a rolling window, right, of the last 30 calendar days or about 20 trading days. And so now with some of those really explosive moves higher have rolled out, you can see that realized volatility, which is the green line here, 1 month realized volatility, is cratered, going from 14 down to 11. You can also see that our 5-day window's down at 5% right now, which is about as low as it's ever gotten, that red line. So realized volatility right now has really come down tremendously over the last really week. Yes, it was Thanksgiving, but we're at what, 10%, right, in the S&P over the course of about a month. So let's bring that up here so we can make that case, make sure everyone can see that move. So this is tremendous realized volatility, right? This explosion higher, and now we're stalled, right? And realized vol is coming down. So with that, we would expect the VIX to come down and volatility writ large start to come down and really express this. Now VIX is at 12. Late on Friday, it just got decimated right into the holiday kind of weekend. So the VIX has really compressed. And as we've talked about recently, we have some data that says that the mean distance between 1 month realized volatility, which is this green line, and the VIX is about 3 to 3.5 points. That's the long-term mean. So if you say, okay, Brent, well, what's fair value for the VIX based on this metric? You'd add, let's just say 3 points to this. So 14 VIX is roughly fair value. Now, vol's been coming down, et cetera, but the VIX at 12-ish or in the 12s, you can make then the case for that the VIX is starting to become maybe a little bit too cheap, at least in the short term. Now, the VIX is a standard 30-day measurement. We have holidays coming up, all this other sort of stuff. And so that's a pretty crude barometer, I'll give it to you, in terms of saying, hey, is implied vol cheap or expensive? I think that you could certainly say it is at most, it's fairly valued, right? Edging on cheap. You certainly wouldn't sit here and say, hey, there's just a lot more collapse to go based on where realized vol is at that 11 mark, right? So the VIX is very low. I want to just flip through some of these other metrics that you can look at. We've talked about this one recently, VOLI. VOLI shows you at the money spider volatility, again, 30 days out in time. It's as low now as it's been at any point this year. If we zoom back farther, you got to go back to kind of these 2000 and maybe a brush with it in mid 2021. 2021, of course, a very bullish year. So at the money volatility, very low. If we look at the SDEX, which is another nation's index, this measures the price of a 1 standard deviation out of the money put, 30 days out in time, again, 1 month out in time, versus the at the money. So what does it cost to buy just a slightly out of the money put? Right now, it's cheaper than it's been in a long time. And that's not tail risk. That's just sort of, hey, do we think the market's going to go down? Even just 1%. Most people not betting on that. VVIX, another one people like to look at. VVIX is essentially the price of out of the money calls in the VIX, right? If you think the market's going to go down, the VIX pops. What do you buy? Will you buy some out of the money VIX calls as a tail hedge? That has collapsed as well. So all of these metrics you can see are at a lower bound. And I did a video a while about this. It is about the cycle that's in volatility. There's volatility cycles, right? And we push down to lower means and then we tend to pop. Just to give you a rough example of that, you can see this, and everyone say, hey, don't do technical analysis on the VIX, right? But the thing that's interesting about the VIX is in volatility is there's a lower bound of volatility. When you have, and let me let me hop away from the screen real quick and look at term structure. When you have current term structure in the S&P shows us that, hey, forward looking at the money implied vols are 8, 9, right, in that general area. Rule 16, you divide this number by 16, you find out, hey, they're pricing in 50 to 60 basis points of daily movement in the S&P 500. And there's no premium, obviously, associated with that, right? There's nothing looking forward to here. Say, hey, there's a ton of risk associated with whatever's about to happen in the markets. The markets are pricing in essentially zero risk, period, right? And so you can't have a day where there's no volatility in the S&P. You could have very low, right? You could have zero, but how long are we going to stay at zero for? Would you bet that the rest of this week would have zero every day or come out zero over time? Well, no. So you have this lower bound, right? And I think historically you start to get into this 50 basis points of expected movement, just like that VOLI shows us, kind of a low since 2021. We're pricing in now less movement now than we have in 2 years. And there's nowhere else for volatility to go, right? We shoved it in this really small box and keep pressing that box. At a certain point, the market's going to move somewhere if the lights just turn on, right? They turn the servers on at the exchanges, the market's going to move a little bit and it starts to wiggle out of this implied volatility range, right? Or estimated volatility range, and that causes vol to expand. So what do I mean by that? Well, if you're pricing in 8.6% on an annualized basis volatility, that's 50 basis points, 60 basis points of movement, and we get 75 basis points of movement. Anybody that's short vol here in these time frames are expecting no movement. As soon as we get some movement, they got to cover, and that starts to expand volatility, and you kind of start another cycle. And so that's what I was getting to with these wedges that we draw, where you say, look, don't do technical analysis on the VIX. Well, it's fine, but there are these wedges where we force volatility into lows, right? Like this box, and there's nowhere else for it to go, and it pops higher. And this happens on a multi-time frame basis if you kind of draw it, in these flagging patterns over, short-term basis. So you can see now we're pushing things kind of into this box, and kind of like in here where it just goes, hey, just a 1% move down, suddenly VIX is back at 15. Vol set is resetting, it's repricing a little bit. And I actually think that's healthier for a second leg higher, or at this point a third or fourth leg higher, wherever we're at. If you're selling premium today, you're selling premium, at extremely low levels. The risk reward gets worse and worse and worse the lower vol goes. This volatility fuel, this is vein of fuel, right? Vol collapsing is fuel to help the market go higher. Well, it works the other way. If vol starts to shift higher, then something that helps to press the market lower. And there's very little fuel left for vol to lift the market higher, because there's nowhere. The lower bound is right there for the floor of volatility. So there's like a little bit of drift left maybe to help kind of prop the market up here. But as far as like the VIX coming down from 20 to 15 and that's shoving the market materially higher, well, that fuel's gone, right? There's plenty of space now for VIX to pop and the market to go down, which doesn't necessarily mean we have to have this catastrophic sell-off. It's just this idea of pushing us back to 4,500.